Life insurance is important to have, but how does it work? If you purchase a permanent life insurance policy, you need to understand that it must be able to pay a claim someday. As a result, the life insurance company would offer you, the policyholder, the lowest premium amount possible, but one that was high enough to ensure that you would end up saving your own death benefit over your expected lifetime. You would then pay this premium on a monthly basis until you die. But that isn't all. What if you get hit by a bus and die early? Well, the life insurance company plans for that as well. They would purchase a 1-year term policy each year to cover you in case you die early. What you need to understand is that the life insurance company is responsible for paying the gap between the death benefit and the cash value. For example, let's say you purchase a $500,000 life insurance policy and your premium is $1,000 per month. That $1,000 that you are paying monthly is known as the cash value of your policy. Over time, the cash value will accumulate and the life insurance company's risk for how much they have to pay out will decrease, since they are only responsible for paying the gap between the death benefit, which in this case is $500,000, and the cash value that has accumulated. The $1,000 you are paying each month is invested into bonds, stocks, and mortgages in order to gain interest and grow your cash value at a faster rate. So let's say you die 10 years after paying into your $500,000 policy. Well, the insurance company would be responsible for paying the difference between the cash value that has accumulated over that 10 years minus the $500,000 death benefit.